Capital for the Common Good, impact investing, and we're talking today about how INGOs and the finance sector work together to expand creative capital for the common good. This is part of a webinar series that we sponsor through our Oxford Impact Investing program called Insights. And our goals through having these seminars, which are free, is to really share as a community groundbreaking ideas to help build our global network and to ultimately shape the future of impact investing and social finance. And I am a talking slide right now. My name is Gayle Peterson. Next slide, Brad. I am program director for both the Oxford Impact Investing program and the new social finance program. I'm an associate fellow at Said Business School at Oxford University, and I want to welcome you to this fantastic session. We start with some visual images, and this is what Said Business School looks like. And we have many alums on, so it's a nice reminder to them in terms of what they might, what they remember about the program. And for those of you who haven't visited Oxford and Said Business School, it gives you a sense of who we are. Today's discussion, again, really focuses on why is new capital needed? What are illustrations of blended capital deals with international non-governmental organizations? What are the challenges and opportunity? We're going to open up for question and answers. But one of the things that's happening in terms of why this is important now, not only do the Sustainable Development Goals need trillions of dollars to fully implement them, but what we're also finding in our classroom is this lost in translation between finance and also nonprofit or civil society organizations moving into the space of impact investing. So we're going to talk specifically about how to bridge that divide. There I am. I'm program director, as I said, and we're joined by Lauri Spengler, who's the president and CEO of Enclude, and Fabian Llinares, Koller, who's the Enterprise Development Program Manager for Oxfam. And Fabian is in the impact investment portfolio, and Lauri's been doing impact investing for decades now, Lauri, I think. Next slide. This particular slide is really a synopsis both. You'll see where there's big blue dots, talk about where most NGO activities are taking place in impact investing. You'll notice that on the continent of Africa, in Latin America, the global south is a priority for NGOs moving into the space. And this is a survey of 31 non-profit, non-governmental organizations now involved in exploring impact investing. The black dots represent our students, where Oxford Impact Investing students come from in terms of geographic locations around the world. And we've been teaching the impact investing program for 5 years. So this is a celebration this year. And but we wanted to give you a sense of where our students come from in relationship to where those investments are being made. And I think that, again, our experience today is to really talk through what we're learning about this divide between finance and NGOs as they come together to do impact investing that blends finance and social change. Next slide. That's an image of our students from first year. What's important about these two pie charts is the first is to really say, if you think about who comes to our program, and we think about the NGOs and charities and finance and professional services, that comprises about 75% of our students over time. And the fact is, those two communities really thinking through finance and social change, how they work together is really instrumental, and it's part of our learning process of how we bridge that divide and allow new capital to be generated. But also it raises a number of questions about what folks in finance need to operate in a social change environment and what social change agents need to operate in a finance environment. And I'll give you one illustration of two students who came last year, financial backgrounds, starting two funds at one of the largest banks in Europe. And their experience was, we need to create an education fund in philanthropy and impact investing that will address the issue of religious extremism. How do you educate children so that they're inclusive and not religious extremists? So that issue is controversial, it's challenging, and it again demonstrates the kinds of challenges that we face in our classroom. We have wide diversity of students. So next slide, please. Why are NGOs getting into this space? Again, primary reason is to expand and scale current programs. The other is, again, to support businesses in target geographies. Another is diversify funding. And what we're finding, particularly in the global south, as NGOs are moving into the space of impact investing, they're feeling the squeeze of philanthropic and international aid dollars. And so how do they diversify their funding stream and their portfolio? They're experiencing potential reduction in dependence on donors. How do you do that wisely? And how do you anticipate and offset any decrease in funding? So there's a variety of reasons people enter the space, but it's again driven by scale, it's driven by need to find new sources, and it's a need to really understand how to reduce dependency on donors. NGOs are getting involved in a number of ways: making investments, receiving impact investing, delivering technical assistance. And we're going to spend a little bit of time talking about that. How do you, in fact, NGOs have a lot of experience. How can they help build the technical assistance for folks in finance who are moving into a space? They know the local politics. They understand how to navigate situations that finance professionals may not know. And they help build that ecosystem of infrastructure, of getting folks to work together in a collaborative way to increase blended capabilities for finance. Next slide. The idea of where does money go and how does it flow? One is it goes directly into enterprises, that's the bulk, through intermediaries, setting up funds, microfinance institutions and others, but really impact investing coming directly to INGOs is becoming a dominant theme. Intermediaries, again, the INGOs are serving as intermediaries or working with big intermediaries, whether they're organizations like Deloitte or KPMG. So there's a variety of ways money flows to them and through them. In terms of where INGOs are focusing their attention, livelihoods, sustainable agriculture and development, and microfinance are the largest investment areas. Next slide. The challenges and opportunities, and again, what we see in the classroom every year, and something that we work on specifically to bridge that divide, is this is uncharted territory for many NGOs. Understanding finance is not something that comes easily and isn't necessarily part of the background. Sharing knowledge within your own organization. One of the first experiences that we had talking about impact investing many years ago was with the Gates Foundation. And that it was very common for the team within impact investing to almost be walled off from program areas where there wasn't a knowledge sharing. Similarly, with some of the larger NGOs with whom we've been working on the ground, there was almost a suspicion about how we move into an area of finance when it's a social change organization. So making sure there's internal alignments. The opportunities, however, again, are going to scale, sharing local knowledge, sector expertise, finding creative ways to blend capital, that's what NGOs are really good at, and also measuring impact. That's been a primary objective for students in finance and in the NGO community. How do we know we're being successful? NGOs go through that rigor as part of receiving funding from different funding sources. And so they have expertise that can be offered in terms of measurement of social change and financial report. I'm going to quickly go through a project that we've been working on in terms of reforming the U.S. community food system through market-based change. Next slide. Specifically, we've worked with NGOs that are part of our portfolio through the Kellogg Foundation. The Kellogg Foundation was actually one of the leaders that launched the Oxford Impact Investing Program and has been pushing the envelope for creative ways to help find new financing for NGOs. And we're looking with a cohort of NGOs for the Kellogg Foundation at the possibility of social impact bonds, impact investing, and working with high net worth individuals to expand new capital. Next slide. The organizations with whom we're working specifically are Healthy Schools Campaign, School Food Focus, National Farm to School Network, again through the Kellogg Foundation. And the opportunity, and this is US-centric right now, is influencing $16 billion public school food sector. And the objective is to, how do you move organizations that have been getting philanthropic dollars into expanding that pot with high net worth individual contributions, or moving into the area of impact investing. Next slide. And one organization in particular who's very savvy at both market-based change is an organization called School Food Focus. And it's again, we're looking at 1 billion meals served in the public school system, and 600 million spent annually in terms of the districts with whom they're working. So it's big money, it's big opportunity, and the next slide, please. Next slide. So the opportunity for School Food Focus has really been, again, how do you influence that $16 billion market is, and that because it's so large, it gives them an opportunity to help companies test new products and to address difficulties in the procurement process. Their work as an informal navigator, working for companies to provide local, healthy, good food to school districts by advising them. One company's increased sales fourfold, another's reported increases of 40% just by talking with School Food Focus and getting their advice. They want to formalize, next slide please. They want to formalize that process so that they can actually become a formal navigator, offer consulting services that will help identify opportunities for vendors, interpret what it means to move through a procurement process, and to increase brand awareness within the school food sector. For them, just to give you a sense of scale, 6 months to sign up first client, $100,000 investment, catalytic philanthropy to help them launch a project that they can think will have significant opportunities for them in the area of impact investing and market-based change. And helping organizations wherever they are in that spectrum, whether you're very savvy like Oxfam, or whether you're just getting started like School Food Focus, has been a priority for what we do at Oxford Impact Investing. Similarly, we help organizations from finance move through that process of what does it take to actually create impact investments with social change and for financial returns. Next slide. And again, this is what healthy school might look like, involving the organizations with whom we've been working. But it's important to remember there are 16 million hungry children in the United States. 1 in 5 children is obese. So not getting proper nutrition, not having access to healthy food is a major issue in the United States. And these are 3 organizations within a Kellogg Foundation portfolio that helps get good food into the mouths and stomachs of children in the United States. Next slide. With that, I'm going to introduce Lauri, who's going to talk about Enclude, his work as an advisor, and how she mobilized what I love is courageous capital. Lauri?
Thanks, Gayle. Thank you so much. Delighted to be here. And as you said at the outset, this is a really important conversation and very timely, no matter where we're sitting across the globe and having this conversation. I'm going to very briefly introduce Enclude, just so you have a sense of the perspective that we bring to the conversation. I'm going to spotlight a set of transactions, impact investing transactions, we have completed with BRAC, which is one of the largest INGOs and largest development organization in the world, as they've expanded beyond Bangladesh to now more than 10 countries globally. And I'm going to conclude with a few of the lessons and insights we've gained from that experience to share with the group and hopefully stimulate some questions. So briefly put, Enclude is a specialist advisory intermediary with a core mission. And our core mission is how can we contribute to building a more inclusive and sustainable local economy around, no matter where we sit around the globe. So it's not a singular economy, but local economies. For us, you can't be sustainable, long-lasting, and resilient without being inclusive. And effectively, our philosophy is we believe in something called a principled prosperity. And what we mean by that is the idea that everyone can participate meaningfully in an equitable, sustainable local economy without confronting an unacceptable trade-off between economic, social, and environmental outcomes. Our mission runs very deep because Enclude is the byproduct of 2 companies formerly known as Shorebank International and Triodos Facet. So we're very fortunate to stand on the mission foundation of Shorebank and Triodos in our work. So as advisors, what do we do? So you're a specialist advisor, what does that mean? The next slide, Brad, please. We have 2 advisory businesses. One we call Capacity Solutions, and the other Capital Advisory. Both actually touch the impact investing conversation, and the reason is that we recognize money alone will not deliver the outcomes that we seek. Advice alone will also not deliver the outcomes that we seek. We need both working together, and that goes a little bit to, I think, what Gayle was teasing out in her opening remarks. On the Capacity Solutions side of the company, we do a lot of high-touch, technical, managerial, operational advice. For example, working with a bank in Nicaragua right now as they are trying to design the right products and services to reach a new segment of women entrepreneur borrowers, helping a whole network of MFIs in West Africa designing new products that are in the sanitation, water and health area, advising government and NGOs. So the government of Rwanda, we've been advising them on their digital financial services policy, and in Jordan, we've been doing a very interesting advisory mandate funded by the Gates Foundation, focusing on utilizing existing digital channels to support the needs of people living in refugee camps. So just to give you a quick feel, on the capital advisory side of our business, we are a regulated business. So we are regulated by the Financial Conduct Authority of the UK. And I emphasize that because this work is becoming highly specialized and complex. And it is, I think, to be expected that transaction intermediation is and will be a regulated undertaking, as it is in other parts of the financial world. So we are FCA regulated. What we do on that side of our house is we help organizations, and a big range of organizations, including today's focus of INGOs, mobilize the capital that they need to achieve their mission. What I always say to impact investors is, with due respect, you're not the ones generating the impact. You are enabling the impact that you say you seek to support. So let's make sure that we're keeping front and center the needs of the operating entities that are delivering on that impact. Our focus is on what we would call investment capital and not grants per se. What we mean by that is there's an expectation of the return trip of capital. It's going to come back. We absolutely use grant instruments, particularly when they're part of a capital structure, in blending scenarios, and I'll speak more to that in just a moment. But I also wanted to mention one other thing we're doing on the capital side is mergers and acquisitions. We've seen now a number of impact investments having been made over the past 10 plus years. When those investments are made in the context of an investment fund that has a limited life, effectively you have to find a way to recycle that capital and generate an exit from the fund. If you don't structure those exits responsibly, what we like to call responsible exits, once again, you run the risk of undermining the impact that for 10 plus years your capital was going to support. So we've really emerged as a leader in structuring what we call responsible exits. Our sectors, we're not sector specific. We do a lot of inclusive finance, sustainable ag, clean and renewable energy, and what we like to call technology-enabled business models to reach new market segments. We're global with regional teams distributed in various geographies, and our clients, as I said, do range from INGOs to financial institutions, donors, governments, incubators, accelerators. So with that, I'd like to, could you move on, Brad? I'd like to spotlight some of the, you can skip that, Brad. I'd like to move on to work that we're doing with BRAC. So hopefully people on the phone are familiar with BRAC. ShoreBank has been working with BRAC for 20 plus years, well before my arrival at the ShoreBank family. I first got involved personally when I went to Bangladesh in 2006 and met with Abid, the founder of BRAC, who shared with me that BRAC was really embarking upon an expansion, moving into other geographies outside of Bangladesh. And he was specifically, at that time in 2006, focused on Africa. They were already working in Afghanistan then, looking at Pakistan. They're now today in Myanmar, other places. But his particular question to me was, Lauri, I need capital, investment capital, to grow and support our microfinance activities initially in Africa. Now, a couple of words of context. One is the reason that BRAC needed to source additional capital is that under Bangladesh law, BRAC is prohibited, as is every other operator, from taking any money generated in Bangladesh and using it outside of Bangladesh. So there was a foreign exchange restriction that applied, still applies today. So that was kind of an imperative, I would say, underpinning this. The second, though, is the recognition that Gayle alluded to in the introduction, a recognition by BRAC that maybe it is time to pivot and diversify the people who can support our activities going forward. Point two, BRAC would never describe itself as a microfinance institution, ever. They are a learning organization, a development organization, but microfinance is one of the core offerings within the BRAC family. And we pinpointed that because it was so catalytic to the other types of interventions and programs that BRAC was rolling out in Africa. And also, pragmatically, we could identify a mechanism for external capital to come into the microfinance activities with the expectation of that return trip of capital. This picture that I'm showing here is complicated, and the reason it's complicated, there are two. Not for the sake of complication. Finance people tend to love boxes and structures and lots of arrows. But what my view is, you structure because you're solving for something very specific. And good finance people who understand impact and understand working with INGOs will really focus on what are we solving for with this capital? What is the ultimate use? And the first deal that we did for BRAC, we closed it in October of 2008. You may remember the financial worlds were imploding at that time, and we raised over $75 million for them in a transaction among 13 investors in 2008. It was what we would call a highly layered transaction, meaning we had different types and stripes of capital around the transaction. And the reason for it is that we felt absolutely it was critical that the local MFIs receive their money in local currency, not hard currency. Why? Because they are lending in local currency. And the average borrower in Uganda is a woman. She wants $200 equivalent in local currency as a loan, and we have to make that loan affordable to her. That was what we had to keep in mind in pricing the deal and in structuring the capital transaction. There were no swaps or hedges available in the marketplace at that time that would maintain the affordability of the capital for that ultimate use. So we had to come up with quite an interesting and complex layered mechanism to attend to primarily the currency exposure. I'm happy to say more about that, but it was really more impressionistic to make that point. Brad, next slide, please. In talking to the investors, I think, again, picking up from one of Gayle's themes, in 2008, BRAC had not ever raised third-party capital for the INGO. They had raised it for BRAC Bank in other places, but not from the NGO. And people loved the kind of BRAC narrative, the BRAC image, the BRAC story, but I think what was so critical is our ability to put in form and detail the type of information that investors needed to see to give them confidence in BRAC's capabilities. So we had an easy job in a way getting in front of people because BRAC was relatively well known. But it wasn't so easy to pull all of the information needed to demonstrate the solidity of their performance in a manner and a form that investors would appreciate and be willing to make a decision against. So this gives you a sense, and over 9 years, they've really done extraordinary work. This is specifically Uganda and Tanzania, just to give you a flavor of that. It's not to suggest that it's been lockstep without challenges and issues, but because the information we were able to present regularly to investors has been so clear and consistent, when you do hit a bump, it also gives you the ability to talk to your funders, your lenders, investors at that point, about what's going on in a much more credible way. Next slide, Brad. But the most important thing for positioning BRAC in the impact investing industry, in my opinion, and one of the reasons we are so enthusiastic about continuing to work with BRAC, is the broader impact story. And so here I'm talking about what we call the microfinance plus model of BRAC. As I mentioned a minute ago, BRAC would never describe itself as an MFI for good reason. And so even though the lenders were financing the microfinance activities specifically, we have from the very beginning of all of these transactions reported to the lenders on all of the other livelihood interventions and programs. Their money is not going into those programs. BRAC raises other money to support those programs. But because microfinance is such an important part of the holistic approach of BRAC, we believe this is critical to be true to BRAC's model, but also for the lenders to have a complete sense of what their money is really helping to enable. And so from the small enterprise program to agriculture to the adolescent girl program, there's a whole range of livelihood interventions that BRAC is known for. So that just gives you a feel. I would say the deal is, as I say, high touch. These are not commoditized transactions at this point, and in my view in finance, in impact investing, we are a long way away from that commoditization, and I think that's for good reason, because we have to be clear what we're solving for in each juncture. So what have we learned? I would say the lessons and insights we've gained, and maybe hopefully bridging that lost in translation challenge Gayle introduced with, fall into 3 categories. One is clarity. The clarity of focus and a compelling narrative. And I think for all of us who do this work sometimes, it's so obvious to us. It's not obvious to investors. And teasing out and being clear on the narrative, the purpose, the sources and uses of capital is critically important. And even more so when you get involved in blended finance structures, which are more common and will continue to be more common. A second lesson is transparency. And particularly our experience working with INGOs, these are complex organizations for good reason, structurally and operationally. Where investors get concerned is how is money coming in from their investment and how is it being used within the organization. So BRAC has a multiplicity of legal entities. Some of those entities, they share office space, they share people, they share all kinds of resources. And we had to be crystal clear in delineating who pays for what within the organizational structure for our deal to meet the credibility and due diligence rigor of investors. This is not a negative. It's not as if they're challenging it and saying, I don't like that. The clarity and the transparency is critical. Second transparency is on what I would call the revenue drivers. What and how is revenue being generated? And not every activity of the INGO generates revenue. And again, that is to be expected. But my point would be, don't pretend it is. Make sure that we are being transparent on where and how revenue is generating and where it's not. And then final would be on risks at the country level, macro, at the meso level, at the market, and micro at the operational. And you need to be proactive. What we've learned is you have to be preemptive and proactive in identifying those, because investors are very experienced navigating through risk, but they want to know what they are and how you are thinking about them. And maybe, sorry, I ended up with three. The final point would be on impact, not just this noise of metrics, but really more the management of your impact, which I think hopefully this last slide helps to demonstrate with BRAC. The third category and final would just be a point on doing your homework with the investor landscape. But we've learned this the hard way. We're on the selling side. We are representing organizations every day in the marketplace. The good news is that the investor landscape is much more diversified than it has ever been before, from family offices and high net worth individuals to foundations to development finance institutions to impact investing asset managers to institutional investors. So that's the good news. The not so good news is there's still a big gap between talk and action. So you can get a meeting and get in front of people, but that pathway between the commencement or expression of interest and the actual investment of dollars or whatever your currency is a long and challenging one. So really understanding and doing the analysis of the investor categories you want to prioritize for a particular transaction is critically important, and then really trying to understand what will resonate most effectively with that target group of investors. So let me stop there, Gayle. Happy to take questions, but hopefully that gives a little bit of a sense of the kinds of things we do and what we're seeing as a result.
No, that sounds fantastic. Thank you so much, Lauri. And again, we've gone from school food focus, which is again smaller in scale, to BRAC, one of the largest, and that's the ecosystem in which we operate. I want to actually go I'd like you, the audience, to be thinking about their questions now. We're going to talk with Fabian, and then we're going to open it up to a conversation with participants, panelists, and keep things moving. So next slide, Brad. Okay, Fabian, do you want to give us introduce yourself and also talk about your work?
Yes, thank you, Gayle, and thanks, Lauri, for an inspiring presentation. So my name is Fabian Llinares, and I am Oxfam's Enterprise Development Program Manager. And I'll give a brief introduction of Oxfam. Many of you will probably know the organization, but it is complex, as Lauri was mentioning. Oxfam is an international confederation of 18 NGOs, actually, working under the Oxfam brand with partners in over 90 countries, really with it to end the injustices that cause poverty. And being a complex organization, our approach to impact investing is equally complex. So I was counting, and there are at least 8 initiatives, programs, and/or funds that Oxfam has launched in the last few years that speak to this impact investing conversation. I could speak about many of these, but to keep it simple, I'll speak about the program that I currently manage, which was, I'd say, our first initiative with the impact investing approach, or enterprise development approach, as we call it sometimes. Oxfam, as an organization, is known for its campaigns, it's known for its humanitarian responses, and for long-term development work, and I think this is really where it comes from. So we've got over 70 years of collective experience working to improve the livelihoods of some of the world's poorest and most vulnerable people, with a focus on the rural poor and very specifically on women. And as part of that work, we've done a number of things. We provide cash, tools, inputs, training, technical assistance. We've supported farmers to organize formally, informally, into producer organizations, cooperatives, and the like, and we've linked farmers to markets. And I think all of that work really kind of leads to why we entered impact investing. Because besides recognizing and acknowledging that businesses play a key role, need to play a key role to overcome poverty, we realized that we needed a sustainable exit strategy for long-term development projects. So it's kind of a natural evolution from that work, and I'd say that's the first reason why we started looking at this space. The second was by working with these farmers' organizations and linking them to markets, realizing that there was and there is still a very real gap in terms of the supply side of capital for these small and rural enterprises, what is called the missing middle. And then lastly, and Gayle has mentioned this before, is really our interest in innovating about how we generate and raise funds, and how we engage with some of our donors and supporters, so really finding new ways of funding our activities. That is why we entered, and when we decided to launch this program, the Enterprise Development Program, we really were looking to create a program that was a business-like program that would promote and support small and rural businesses addressing some of these challenges, and financing being one of the key challenges that these small enterprises face. So we really spoke to several advisors and analyzed the private equity model and tried to adapt it when we launched the Enterprise Development Program to something that we could manage within Oxfam. So that was in 2008 when we launched. And I guess the Enterprise Development Program can be seen as a fund. However, when we raised funds, these are raised still as donations, so not investment. That is, we do not offer a return on investment to our supporters, who are mostly high net worth individuals. But we do offer them a seat on our board. So many of them are people who have been engaged in investing, some of them in emerging countries, which is where we are focused on, and want to give more than just money. So we invite them to be part of the board and guide our strategy as a program. The other thing about the EDP is that we do have I'd say, professional investment committee, which is composed of external investment specialists, and these are the people who we evaluate and approve our investment proposals. The EDP still invests a large portion as grants, so we're really providing blended capital to these small enterprises. And this is simply because we're still there when nobody else will invest. These are risky and early stage businesses that we're investing in. And the commercial finance that we provide, we typically do not provide directly, but we do it by partnering with existing local financial intermediaries. So we've taken an approach where we feel comfortable providing a guarantee so that a local financial intermediary will lend to the enterprises, and that is with the idea that they establish a relationship, and that once we remove our funds, that link exists and the enterprises can sustainably access finance, and also at the same time that the banks learn to understand these enterprises and learn to evaluate the risks. And here is where we've got a great opportunity to partner with people like Enclude, Lauri and her team. So we launched EDP in 2008, and in the first 6 years between 2008 and 2014, we raised £5 million, of which we're expecting to recover about 1 million. So that is what has returned to us from the loan support that we did provide, or what we expect to return to us at the end of the day. We have invested in 23 enterprises in 19 countries, and these have shown great trends in terms of sales growth, also growth in profits. However, after 3 years spent in our portfolio on average, only about 20% were what we would consider viable, so profitable and sustainably profitable over 2 years or more. We did reach 38,000 farmers directly, or these enterprises did work with 38,000 farmers directly, out of which 40% are women. We created 111 full-time equivalent jobs, and we performed deep impact evaluations and household surveys, and these show that the initiative and the investments did provide positive contributions towards increasing income as well as improvements in women's empowerment, which is one of the key indicators that we try and measure and work towards. Additionally, we calculated that we leveraged about £17 million from public and private funds, so that is governments that replicated some of our experiences or other investors that came on and invested in these enterprises. And we believe that our program contributed towards that. In terms of what we learned during that time, one of the key things that seems really simple, but it's the importance of the figure of the entrepreneur. So as I was mentioning earlier, many of the enterprises that we invested in are cooperatives, and therefore lack that figure of a single visionary entrepreneur. So we've tried to substitute that through managers, but you need a kind of committed person that has got the credibility and the leadership as well, and that has been one of the key areas where we have focused and also channeled our funds towards. We've also learned that 3 to 5 years to reach viability in these very, very remote areas and early stage unsophisticated enterprises is not realistic. 6 to 8 is probably more realistic. We've also learned that we needed more focus. We invested in 19 countries, as I said, so we had an external evaluation also come in and tell us you need to be focused either geographically or by sector. We were simply spread too thin with this program. And another big thing that we learned being an NGO is that shifting the paradigm for ourselves, for the partners that we work with in country, and for the enterprise that we support is very, very, very complicated. So coming in with the idea of deploying more commercial capital is good, but getting the people to really understand what it means in terms of ways of working and engaging is really complicated. The other thing is, as I said, we work through banks and local financial intermediaries, and changing the way they work and the way they assess the risk of these rural enterprises is really complicated. And again, there's a great opportunity for us to partner with Lauri and her team here. And lastly, we've also seen how this space is crowding up since 2008. As Gayle mentioned earlier in the presentation, many NGOs are entering this space, and we see this as a really good thing. However, as Oxfam and as a program, we need to be able to understand and better articulate how it is that we are adding unique value. In terms of where we are now and what we're offering, so we're raising a second stage of the fund. Our aim is to raise £6 million between now and 2020, recover 1.5 million of those. We hope to invest in 35 enterprises in 5 countries now instead of 19. These are Bangladesh, Ethiopia, Honduras, Nepal, and Rwanda. And in these countries, we have already strengthened our local teams with specialized staff that have the skills needed to do this kind of work. Our goal is to reach 75,000 people directly through these enterprises, of which we hope that 40% will be women. We hope to create 250 full-time employees. In terms of our criteria to select these businesses, we really...
Fabian?
Yes.
Gayle, if Brad said there are a number of people with questions. If it's all right with you,
Sure.
What we'll do is we'll put some background information, a brief on Oxfam's program, as well as Lauri's, but I think it'd be great to get to the questions if you don't mind. Yeah?
Absolutely, yes, we can jump into the questions, absolutely.
That'd be fantastic. So Brad, of course, colleagues who are watching this and listening to us, there's always technology issues in every presentation. Brad, I've not seen the questions, so if you can shift and ask those, that'd be fantastic.
Of course, absolutely. Okay. So we've got a couple of questions that have come in. The first one is from a gentleman by the name of Frank van Gansbeker. And Frank's question is, how is social impact monitored and gauged? In other words, which KPIs are managed and against which benchmarks are being used to monitor performance, and how does it fare against mainstream benchmarks? So I guess the gist of the question is, what are the current KPIs getting used, I guess popular in the mainstream, and how do those measure up against mainstream investment benchmarks?
Lauri, do you want to answer that question?
Sure. Thank you. Terrific question, Frank. So the starting point is you're exactly right that social impact should feature prominently in all of these impact investment transactions that are coming to market. And I think it's fair to say it is featuring prominently. The GIN, the Global Impact Investment Network, has published something called IRIS, which creates a list, a real long menu list of metrics by different sectors and different categories. It has become, I would say, the go-to list for people to lift from when they're trying to put in place the specific individual metrics. So there's a good resource out there, Frank, and increasingly there are other resources. But, there's a big but, our view, Enclude's view, and increasingly we're seeing traction with investors, it's about measuring 5, not 55 things in a deal. Because the burden of reporting is on the operating entity, the INGO or the enterprise, as Fabian was highlighting in his remarks. And ultimately, for this to be relevant, if your thesis is your money's doing more than making money, it's having impact, then the thesis should be driven by, well, what is the business all about? And those 5 metrics should be relevant to what the business is solving for, which leads to my next point. Ultimately, then, you're really benchmarking in the first instance against the plan of the business. What are they saying they are going to do with your capital from a social impact and reach point of view? So we're having increasing commonality of language and individual metrics through good work like the IRIS list. But the application, the whole art of this is the application into the specific business, making them a narrow set that are relevant to what the business is performing. Now, because of the reasonable body of work, some things are popping across sectors. So when you're looking at a clean and renewable energy deal, energy is kind of the easiest one because there are some very common metrics that people like to examine, the reduction of CO2 emissions, for example, the affordability of certain levels of gigawatt energy. There's a handful of things that people are beginning to look at across portfolios, not just at an individual level. My final point, though, would be in mainstream finance. This is where I think we are so far ahead of mainstream finance because the ESG, the environmental, social, governance indicators, in my opinion, are very limited. And I think our industry is wildly ahead. And I think the challenge and the opportunity is to invite more mainstream, traditional transactions and financiers to engage with us and start to look at the externalities, the negative environmental results that are coming out of some of their initiatives, the negative social results, and try to not just make this a conversation within the impact investing industry, but to make it a broader conversation.
Well, and I think, Lauri, that's exactly right. I mean, and again, this is a nuanced piece, and that's where INGOs, because they've been measuring social indicators and economic indicators for impact, are really changing the rules of the road. And I think that relationship is the IRIS standards are a good first step, but the reality is the nuance involved is where INGOs can really help navigate performance measures, and I think in really creative ways. Brad, let's keep going.
Absolutely. Great. Our next question is from a gent by the name of Luca Martini, and Luca asks, as investors, do you also include multinational corporations, and are they willing to integrate impact investing initiatives into their business models, e.g. partnerships with social enterprises?
Well, that's interesting. And the answer is yes and no. I think there are many corporations and multilaterals, multinationals that are moving in that direction. It really requires a commitment by leadership at a CEO level to actually, from our experience, to do that well and to maintain and sustain that commitment over time. Fabian, do you have an example, or you want to respond to that question?
Well, as Oxfam, we have partnered with large multinationals and trying to help them figure out how to improve their supply chains so that they are fairer towards the poorest people. But I agree with your answer. It is a complicated relationship to manage, and it needs to have senior leadership and a really long-term commitment. But it's one of the areas where we have been working on, certainly, absolutely.
And great opportunity, but again, it has to come from deep commitment to incorporate performance measures into those corporations to actually demonstrate long-term commitment to those relationships and investments. One more question, Brad, and then we'll turn it over to you. And we'll also say those questions that aren't answered, we will give you responses from our panelists and post them on our website. So with that, Brad, one more question, and then we'll turn it over to you.
Okay, great. We've got a question from Samuel Yeboah, and he asks, how is Oxfam able to effectively perform portfolio management with the geographic spread of investments in their portfolio?
Okay, Fabian. Yes, it's a really good question, and I think I mentioned that one of the things we realized is that investing in 19 countries was just too much. We were spread too thin. So the truth is we weren't able to do a portfolio management in the level of quality you may expect. This is why we've narrowed it down, and it's really about being able to work in multi-country teams and in international teams. So now we're in 5 countries, and we're a global team of 10.
And Gayle, just very I would add, I think that's a really good point, Fabian. I would add that another example to look at, Samuel, is Habitat for Humanity. And when they decided to launch a fund, they teamed with Triple Jump. In part to the hypothesis embedded in your question, Habitat for Humanity recognized they had incredible assets, especially with their local presence. So from a pipeline point of view, community knowledge point of view, lots of things. But they didn't have the portfolio management experience that investors were seeking. I'm not comparing it to Oxfam, I'm just saying as a different example. So they when they tendered for their fund, they purposely tried to team with an established private equity manager and do it in tandem. So that's a good example.
Triple Jump was originally set up by Oxfam in the Netherlands.
Exactly.
So it's a great
Sorry,
example.
that's right.
Yeah, that's
Sorry, I forgot that history. Thank you.
Well, and I think that for us, this is a wonderful way of closing and illustrating those relationships, the blending of what an INGO does has to be reimagined and how it fits in the financial sector. Similarly, where big corporations or in investment banks or anyone from the financial sector moving into the social change area, how do we bridge those divides? And I think Oxfam and Enclude's work illustrate successful integration. The reality is this is a pioneering field. And what Oxford Impact Investing does is it helps us to get to a place where we build those relationships and get out of the lost in translation, actually moving into doing deals that have social, environmental, and financial returns. With that, Brad, I want to turn it over to you and say thank you to everyone who participated. Brad's going to say a few words.
Okay, great. Thank you very much, Gayle, for convening this fantastic webinar. And I also want to thank Fabian and Lauri for their contributions today. We really appreciate your time, and thank you very much for joining us. The next part of the conversation, a quick and short part of the conversation, will be just a quick overview on our impact investing and social finance programs, which we run here at Side Business School, the University of Oxford. A quick and brief overview of our history. We launched the program for the first time in 2013, and we'll be celebrating our 5th anniversary this year. The program has been fully subscribed now for the last 3 years and was subscribed for the first time before Christmas. And it's been quite interesting to see the evolution of this program in terms of the types of participants that attend it. So with, I guess, not the maturing of the field as it's a very nascent field, but we've noticed in the first couple of years of the program, and especially in the last 3 to 4 years of the program, the audience has shifted from those that work, I would say, in community development finance institutions, foundations, charities and NGOs. We still fortunately have a number of those that attend our programs, but I guess one of the encouraging signs that we see is we are getting more commitment from mainstream financial institutions. So over the last couple of years, we've been fortunate enough where large institutional investors, such as pension funds, are attending our program, wanting to educate themselves about this area. We get a number of investment banks and wealth managers that are having to consider strategic questions around how they go about designing the strategy and the products that come with that to service their respective client bases. And a number of senior professionals from investment banks, senior philanthropists, have actually used our program to define and redefine their philanthropic and impact investing strategy. So I would say it's more than just an executive program. It's a program where a number of aspirational individuals, typically from 25 to 30 different countries around the globe, come together to share opportunities, challenges, and how they can make a difference in this sector. One of the most powerful aspects of it is how they learn from one another, and they get to see the different perspectives of those who are involved in the greater social finance and impact investing industry. So it's been fantastic to be a part of that for the last 4 years. One question which is becoming particularly prevalent in my conversations is we're in the process of launching a new social finance program to complement our impact investing program. We are the only business school in the world to offer a complementary set of executive programs in this very aspirational industry. And I'm really happy to continue the conversation to discuss the nuances between our impact investing program, which has a focus on deals, impact measurement using policy as an accelerator, and looking at innovative financial instruments like social impact bonds, and how that compares and differs with our new social finance program, which focuses on layered capital approaches. So how do social entrepreneurs and social finance funds create or bring in different types of capital into their structuring at different stages of their evolution. So we cover layering capital or hybrid capital approaches. There's a number of different terms. One of the big parts of the social finance program will be a look at some of the disruptive global themes that I guess that is happening right now in the industry. So just to give a quick example before I end off the conversation, one of them is the Smart and Sustainable Cities Initiative with the Ivy Foundation, Bruce Lauri, in Canada. And how can you take an initiative like that and scale it up from the local or national level and potentially roll it out internationally? So one of the big, I would say, unique selling points of our new social finance program would be, how do you take good to scale, or how do social enterprises scale up their operations? So I look forward to having those conversations with you. My name is Brad Peaston, and thank you very much for joining today's webinar. I really appreciate you giving out your time. So thank you very much for joining us today, and I look forward to carry on the conversation with you in the future. Thank you very much for your time.
Thanks, Lauri. Thank you, Brad. Thank you, Fabian. Have a good evening and a good day. Thank you. Bye.
Thank you and goodbye.